That's a great idea.
Shut that door. Sorry.
Oh.
Break the door.
Shut up.
All right. One thing I want to talk about today is a lot of people, when they're shopping rates, basically they're trying to look at the lowest interest rate. The lowest interest rate is not always the best transaction for you from a cash flow standpoint. As an example, you could get I just got off the phone with a gentleman. You could get 3.25%, no closing cost. You're paying mortgage insurance and your payments, as an example, $900 a month. To where if you did a 95% loan with no PMI, you would be at 4%, but your payment, as an example, would be $850. So at the end of the day, in his scenario, we're actually going from a $70 savings at where he's at if we just refinanced it, gave him the lowest interest rate with no closing cost, made him pay mortgage insurance, and he was saving about $70 a month. Where when we ran the scenario of doing a no mortgage insurance loan, in other words, the lender pays upfront a policy that covers the insurance for the life of the loan that protects them. His payment ended up being $140 a month. So it was double the amount of savings, even though it was a higher interest rate. And the only reason you would do something like that is if you're at a very high loan to value. You really wouldn't start doing lender paid mortgage insurance if you're below 85 or even possibly 90%, depending on your overall mortgage finance plan. So the lowest rate is not always the best deal, so kind of keep your mind open and listen and see what other options are out there besides just the lowest interest rate.